Welcome to the deep dive. Today we're putting on our investor hats, really digging into two giants of American auto, Ford and General Motors.
Yep. Big names, lots going on with them.
Exactly. We've looked at a bunch of market analyses, financial reports, all that stuff, to tackle what feels like a really key question for you, the learner.
Which is?
Well, with everything happening, the big shift to EVs, trade issues, tariffs popping up, the whole global economy picture.
It's messy.
Does it actually make sense right now to think about putting investment dollars into Ford or GM?
It's a fair question. A lot of, let's say, headwinds.
For sure. Lots of question marks. But as we sifted through the sources, something specific jumped out. A theme, really.
Okay.
A potential reason why these stocks might be interesting despite all those challenges. And it boils down to how they're giving value back to shareholders.
Right. Shareholder returns. That's crucial because, you read the headlines and it's often doom and gloom, or at least focused on the hurdles.
Yeah, the EV transition costs, competition, China.
All very real things. But when you look at their capital allocation strategies, how they're actually using their money, it tells a different story.
A potentially more positive one for investors, perhaps.
Potentially, yes. They've both made returning value a priority. Different methods, mind you. But the intent is there, and that's key to understand if you're considering them today.
Okay, great. Let's unpack that then. Starting with General Motors, GM. Their stock, it's had its moments, but the company seems to think it's, well, maybe undervalued.
That seems to be the signal, yeah. Look at their price-to-earnings ratio, somewhere around 7 times earnings. Pretty low for the broader market.
Right. So what are they doing about it? The main strategy seems to be buying back their own shares.
Exactly. And it's not just a casual thing. It seems quite deliberate, a big part of their financial playbook.
How big are we talking?
Well, just back in February, they did 2 things. First, they bumped up their quarterly dividend by a significant 25%. That's nice for income investors. But, and this is the main point here, they also rolled out a new $6 billion share buyback program.
$6 billion.
Wow. And they specifically said they plan to buy back $2 billion worth pretty quickly in the first half of this year, 2025.
So they're not messing around. They think the stock's cheap and they're buying.
That's the strong implication, yes. A real conviction move.
And our sources mention this isn't new for GM, is it? This is kind of a continuation.
That's right. It's a trend. Over the last couple of years, they already finished off a $10 billion share repurchase program.
$10 billion before this new $6 billion.
Correct. So they've already meaningfully reduced the number of shares out there.
So beyond just this latest news, what does that consistent buyback activity really, signal about their confidence?
Well, a couple of things, I think. First, management must believe they're generating enough cash, enough to fund the EV shift, invest in the future, and still have plenty left over to send back to shareholders.
Makes sense. Cash generation is key.
And second, by buying when they think the stock's cheap, they're basically saying, we believe in the underlying value here. And they're trying to give existing shareholders a bigger piece of the pie, potentially boosting the stock price too.
And there's data backing this up, showing the share count dropping?
Oh, yeah. Sources like Y Charts have visuals showing that reduction in outstanding shares pretty clearly. And you often see a generally positive stock price reaction when these big buybacks are announced.
We even pulled a quote from GM CFO Paul Jacobson. He said something like, moving forward, we expect to continue returning excess capital and further reducing the share count.
Pretty direct message from the finance chief. Sounds like it's core to their plan.
Yeah, seems baked in.
Now look, you have to be balanced, right? For you, the learner, it's important to know the risks.
Like the tariffs we mentioned. Or a recession.
Exactly. Our sources flag those. Things like new tariffs or a serious economic slowdown could definitely hurt profits and, maybe force them to slow down the buyback pace.
Sure, they need the cash flow to do it.
Right. But the underlying intention seems crystal clear. They see that PE of 7, they think the market's missing something, and buybacks are their tool to try and correct that.
Okay, so that's the GM picture. Focus on buybacks, trying to boost the stock value. Let's switch gears now and talk Ford.
Right, Ford. Similar goal returning value, but a different path.
Yeah, their main tool seems to be the dividend, right? Offering that more direct, regular income.
Precisely. Ford's really leaning into what our sources call a lucrative dividend yield. They just declared their regular quarterly dividend, 75 cents per share, predictable income.
15 cents a quarter, okay.
But the interesting bit with Ford, maybe, is their use of supplemental dividends.
The extras, not just the regular payment.
Exactly. on top of the regular ones. They've done this in recent years and actually paid out another $1.15 per share as a supplemental just this year, 2025.
So double the payout recently, effectively. For income seekers, that must be appealing.
It can really add up, yeah. And when you factor in where Ford stock price is currently trading, our sources described it as somewhat beaten down. That regular plus the supplemental adds up to a current dividend yield of, get this, 7.4%.
Wow, over 7%. That's definitely high.
It's a number that catches your eye if income is your priority.
Now, hang on. Sometimes a really high yield can be a red flag, right? Like, is it sustainable? Is the company in trouble?
That's always the question with high yields. Good point.
That.
But the analysis we looked at suggests Ford's dividend seems, well, reasonably covered for now. Their payout ratio is just under 41%.
Okay, payout ratio under 41%. What does that mean in plain English?
It means for every dollar of profit Ford makes, they're paying out about 41 cents as dividends.
Leaving almost 60 cents.
Right. Leaving nearly 60 cents for everything else, reinvesting in the business, paying down debt, maybe saving for future dividend increases, handling unexpected issues.
So a ratio under 50% usually suggests some cushion, some sustainability.
Generally, yes. It suggests they aren't stretching too thin to make the payment. It provides a degree of confidence. And again, looking at the historical data like on Y charts, you see a pretty long-term commitment from Ford to paying dividends.
Okay. But just like GM, Ford isn't immune to problems, right? Those same tariffs could hit them.
Absolutely. Tariffs could squeeze their profits, no doubt.
Yeah.
And if profits get squeezed, management might get more cautious about, say, big increases to the regular dividend, or maybe decide against paying a supplemental dividend in a tough year.
So the extras might be less reliable than the base.
Potentially, yes. That's a fair assessment. However, there's another factor supporting Ford's dividend commitment.
Oh, what's that?
It's the Ford family. They still own a significant chunk of the company and have substantial control over the board.
Ah, family control. So their interests are aligned with getting dividends.
Very much so. A healthy, reliable dividend directly benefits the family's own finances. So there's a powerful internal incentive to keep those dividends flowing. What's good for dividend investors is good for the Ford family.
Interesting dynamic. Okay, so wrapping this part up. GM buybacks to boost the stock. Ford dividends for income, bolstered by family interest. Two clear but different shareholder return strategies.
Exactly.
So for you, the learner, trying to navigate this tricky auto market, what's the main takeaway here?
I think the core point is this. Yes, the challenges are real. Big ones. The EV shift, global competition, trade stuff, it's all uncertain.
Right.
But despite that, both GM and Ford are giving investors a tangible way to potentially see a return right now.
You mean you're not just betting on them winning the EV race or solving all the trade problems?
Kind of. The investment idea here isn't solely based on predicting their massive future success in a turbulent market.
Yeah.
It's also about investing in companies that are actively, deliberately sending cash back to their owners as shareholders.
Through these different methods we discussed.
Through buybacks or dividends, yes. So if you're thinking about adding a mature automaker to your portfolio, looking at how they return capital gives you another angle, another reason to potentially consider them beyond just the core business outlook.
That makes sense. But it's crucial, and our sources stress this too, for you to remember these returns aren't guaranteed, are they?
Not at all. That's a critical caveat, whether it's stock appreciation from buybacks or dividend checks.
A major economic downturn could put a stop to it.
Absolutely. No company is totally immune. These strategies rely on the companies generating enough free cash flow.
And in a bad recession.
That cash flow could dry up or at least shrink significantly. That could mean buybacks get paused or dividends get reduced or suspended, even temporarily. It happens.
Right, got to keep that risk in mind. Okay, so let's try and boil it all down for you, the learner. The main insight from our deep dive today, based on the material we reviewed, is that maybe the strongest argument for owning Ford or GM stock right now isn't just pure optimism about their car businesses navigating all the storms.
Although that still matters, of course.
Of course. But the really compelling bit, according to these analyses, is their clear, active commitment to returning value directly to you, the shareholder.
Yep. Ford via dividends, GM via buybacks.
It's a tangible benefit, potentially, even while the bigger industry picture remains kind of fuzzy.
Precisely. It provides something relatively immediate for investors while all that uncertainty plays out.
Okay. And that leads us to our final thought for you, the learner. Thinking about your own goals, your own comfort level with risk. Which way do you lean?
Yeah, which approach fits you better?
Is it that potential for steady, maybe growing dividend income from Ford with those possible supplemental kickers?
Or is it the potential for GM's buybacks to maybe lift the stock price over time? Does that align more with how you want your investments to work?
And maybe the deeper question is, what else do you need to research? How sustainable are these payouts and buybacks really in the long run, given how fast the car world is changing?
That's the homework, right? Digging into the sustainability question for both companies as things keep evolving, definitely worth exploring further before making any decisions.
Absolutely. Food for thought. Thanks for joining us for this deep dive.